Let's bring in our friend Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower, as well as a CNBC contributor. So you think, Stephanie, that the rally has some legs, at least through the end of the year, based on the data?
Definitely. Tyler, good to see you. It is the inflation data. Certainly, that's one of the catalysts. But there's a couple of other things. It's the economy is continuing to see expansion. We're going to see 2.5% growth. That's what we're tracking right now for the fourth quarter. I think the Fed is done because of the inflation coming down, and you've seen a peak in rates. And then just throw in seasonality for good measure. And I think all of these things combined will lead to market continuing to do well into the end of the year, and probably a little bit of chasing as well.
What sectors do you like the most?
Well, I think you have to have kind of a diversified strategy. I think there's nothing wrong with technology. Even the Magnificent Seven, I own a few for sure. And I think they will continue to do well. It's hard not to get excited about the total addressable markets in AI, in cloud, in security, et cetera. That being said, it's a big piece of the overall market at 35% in terms of weighting. I think you also want to have some exposure on the industrial side. You and I have talked about onshoring and reshoring all year long. I think that is a 10-year theme, and I think it's going to continue to be strong, and we saw it last quarter. And I think anything tied to aerospace is also doing well. Look at the Boeing upgrade, for example, today. I do think energy can play a little bit of catch-up. It's kind of frustrating, as are the financial sectors in general, but I do think you can find some pockets of really good ideas in those two sectors as well.
Steph Ariewald was talking about some stocks last hour and mentioned kind of in passing that he thinks we've moved past the mid-cycle correction phase into a next leg or maybe a final leg of the bull market. And then with a couple extra seconds afterwards, I asked him, well, how long can that keep going? And he said, maybe until the first Fed cut, which, as we know, could be who knows what time next year. Does that feel like it's right to you? Like that's the kind of stage that we're in right now?
It's hard to tell because there's just so much underlying stimulus in the economy, Kelly, right? I mean, like we just grew 4.9% in GDP last quarter alone. And I actually expected us to slow down substantially from that. But I think 2% is pretty respectable. And I think we're going to continue because you do still have a lot of infrastructure stimulus in the economy that hasn't even entered into the economy. It always takes a delayed amount of time. And so I think that's going to be a nice stimulus. I think we have to watch for jobs. Jobs continue to be really good in terms of the strength, wages, and I think the consumer, just if I listen to what all of the retailers said last week, the consumer is not dying. The consumer is picky and choosy, and they are doing things in services. They are doing things in goods. I think you have to be a stock picker. But by the way, I was very impressed with the profitability of these companies in the face of some of the headwinds on the demand side. So I think that as long as the consumer hangs in and then you have some of these tailwinds from the industrial part of the economy, that's a big part of the overall economy. And that should lead to pretty decent earnings, especially when you add on the technology movement as well.
Speaking of adding on, you've added on to your holdings in Target just today.
Yes. So I think they did a really good job in terms of controlling what they can, meaning execution, meaning cost cutting. They beat operating margins, Tyler, by 120 basis points this past quarter than expectations. They beat gross margins by 273 basis points relative to expectations. That's really remarkable. So their operating margin came in at 5.2%, and everyone was expecting 4%. And their goal is to get to 6%. And if they can get to 6%, you're looking at $10 in earnings, $9.50 to $10 in earnings power. And I think that's really an attractive valuation at 13 times. If we get the demand that comes back, you're going to have more massive operating leverage to the bottom line.